Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number, or actually our email, is edward@bestofinvesting.com. Use that email to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate's not sponsored by the radio station, which we used to be on, but it's by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today we do have a special guest, Thomas Powell of the Founder's Office. I'm going to read a little bio here. Thomas is a strategist who's been in the fire and still walks through it for the people he serves. Over the last 3 decades, he's structured over $3.2 billion in capital, led global funds, shaped policy at the highest levels, and built a reputation for turning risk and regulation into opportunity and advantage. He's a doctor of law and policy, a constitutional strategist like that, a real estate developer, a global skier, a father and grandfather. I just became a grandfather last year, so I know what that's like. And perhaps most of all, an unwavering advocate for those still crazy enough to build. All right, I like that. Thomas, welcome to The Best of Investing.
Edward, thank you. And I appreciate that my mom wrote that bio for me. You know.
I can have my wife write mine.
Yeah, no, it's not true, but whoever wrote that, it's really interesting who put that together.
Well, wait, are you a global skier?
I am a global skier. Yes, actually, we have. So, it's not what you are specifically working on, but we work a fair amount. We started our first fund in '92 in Silicon Valley. I came out of banking in Silicon Valley, and so that's led a lifetime of being in the VC private equity space and private banking space, both in real estate, but way outside of global real estate. This March 1st, so I'm going to put a little plug in there. This March 1st, we're doing a lift pitch to benefit a nonprofit ski mountain up at Lake Tahoe, which is going to have half venture capitalists, half founders looking for money, including real estate, right, type scenario out there. That is, you have to make a pitch on the lift as you're going up, and you're going to be riding the American chair. And then that takes me into the week where I'm skiing here in the Sierras with a bunch of Olympians and World Cup skiers. So yes, I am literally, that's what I do is I ski, and everything else is to support that pathway of skiing. So if you want to check that out, it's lift pitch or Tahoe lift pitch Tahoe. I'll get that before we close out. But and people are welcome to come up to Lake Tahoe and do that. I know you're not too far from Tahoe, so that's great.
No, about 3.5 hours. But the best part about that is when you're on a lift, you got a captive audience, at least for a short period of time.
Absolutely. Right. I mean, that's why we did that. But you have them, and if they can't wait to get off, then you've got one thing, right? But if they can't wait to hear more, then you've got a whole different thing. And so we try and coach founders and investors.
If the lift gets stuck halfway, well, you got. I mean, as a partner for minutes or hours.
You're totally there. Exactly. So that's great. So that's what we're doing. So it's really all tied around. It's just another reason, as my wife would say, for me to go skiing, which is really what it's all about.
Yep, I get it. All right. So many investors focus on returns, but you focus on structure. Where do you see people taking risk without realizing it, even when their investments look successful on paper?
It's an interesting question. So what I have found over my, coming up on 4 decades now, but over 3 decades of investing, is people are always excited about their returns, and we talk about that as cocktail conversation. It's even how Bernie Madoff, hey, I'm getting 12%, I'm getting 12%. People would share that in 12%, but very few people were looking at what the risk is and what the long-term return is, and how possible and probable is it. And a lot of times we'll say this: when investors make an investment and it does well, that's the investor. When the investment doesn't do well, it must be the person who created the investment. Right? So the structure really comes in there of looking at the risks that are known and unknown. And over the years, we've come up with a capital alignment method that says if you look at the whole of the investment, it's not just about the returns. Some of it could be about how are the taxes being impacted. I saw a great conversation yesterday about a new buyer buys in on a building. It's a 6 cap rate. They're super thrilled about it. They don't realize it's in Texas. The tax rate on the building resets because of the new purchase price. And
Yeah.
so all of a sudden that makes that cap rate far less valuable, which actually means that value of the building after they acquired it dropped tremendously because the cash flows dropped.
But don't they usually, when people are buying a building, one of the things they look at is, oh, I'm buying a building, but their basis was really low. Mine's going to be higher, and figure out how much the taxes are going to be ahead of time before they buy the building?
You would think so, but this was a case study that we're looking at. They didn't, their realtor never walked through that, multi-million dollar investment, but they're not truly in the professional world of investing. That doesn't
Yeah.
happen to a REIT. That doesn't happen to professional investors that have learned that over time. It happens to somebody who generally grew up an investment portfolio and all of a sudden they're not used to that. They transfer a property in and they're like, oh, taxes jumped up tremendously. So
Yeah, because
that's the whole capital.
I own property where I've owned it since 1994, and so I have a fairly low basis. And because I have triple net rents, that gives me an advantage over new buyers because my real estate taxes are lower than the average person or average
Absolutely.
building. Yeah, so
Yeah.
that kind of advantage. Um, Let's see here. Okay, so you've seen capital markets across multiple cycles. What patterns repeat every time markets get uncertain, and what do disciplined investors consistently do differently?
It's again an interesting question. The thing that is consistent is the inconsistency. But also with that, what it says is when we hear words, and I know you've had to have heard this over your times in the investment world, is, oh, it's new fundamentals, or no, this is a different time, right? And we heard that in the late 80s, and then in .com 1.0, it's like, oh no, fundamentally it's different. And then we heard it again in the 2000s as things are building up, and it's like, nope, these are new fundamentals. We're in a new core. And then now today we hear within AI, it's like, no, you old people just don't understand what's going on. These are new fundamentals. And as humans, we really don't have new fundamentals. We just have cycles. And the cycles can be 7 years, they can be 10 years, 17 years, or they can be 100 years. It depends upon what it is. Most of them are driven by bubbles, and most bubbles are driven by credit. And so when you look at that in there, because people are buying something when it's not really their money. And so if you look at that, so that's one of the primary things that transcends all of time. And you can go back and read Tacitus, in the year 00, essentially 53 is when it was. And he's talking about it's the lenders that caused this bubble because people were borrowing money to buy the assets. So when you've got 2,000 years of that as history, we can always look at that. So from our standpoint, we're oftentimes looking at where are the credit cycles now, and we're seeing banks continuing to tighten up once again in most sectors. And so that means when the banks tighten up, there's less access to those assets to be able to be borrowed. So it only leaves cash buyers or buyers that have non-institutional kind of capability. So when there's less buyers, that means values become a little bit repressed, maybe not totally depressed, but they do get impacted. So that's how we look at it and consistently look across cycles of where are you in the cycle, in the lending cycle at that point.
Very good. So funny you're talking about how nothing new under the sun, basically, and I've told this story before on the air, but you probably haven't heard it. Where it's so funny because I was thinking about like when Amazon first started, all they did was sell books. That was the whole idea, and I kept thinking, I can't imagine how this company's going to stay in business. Well, they kind of themselves, right? And back in the 70s when I was in college. I took a computer class, and all they did was like core. Back then, it was just Fortran and COBOL and stuff. I just didn't really care for it. But I remember our professor telling us, there's this new company, these couple of guys in a garage that come out with some computer. They're going to try to compete against IBM, and it's going to be a smaller computer, and they named it after a fruit like peach or pear or apple or something like that, right? And I remember raising my hand and saying, "It'll never work. You can't go against IBM." Ooh, I was wrong. So, I mean, a better mousetrap, because AI is a new thing, but how is it going to change things? People, it still makes mistakes. You're still going to have humans involved in it.
Absolutely. I think it'll do the same thing somewhat that, computers really did democratize much of the world. It gave a transfer of information as it became a desktop on everybody's desktop, as Bill Gates would say, and Steve Jobs was a little different about, he wanted to have it highly functional and easy to use and look beautiful out of the box and usable right out of the box, right? And by the way, I tore apart an old Apple Lisa in the later 80s when I was playing around with those, because I had an old Amstrad 512K computer. So 512K was floppy disk type scenario. You get in there, green screen, wasn't even a blue screen of death. So yeah. So, you got to love all that. I think AI is going to do the same thing. You and I would remember the Dewey Decimal System, and where you go to the library and you used a card and you took it over to the librarian, and Google said that was going to kill libraries, and it really didn't. And it definitely didn't kill librarians at large scale universities, because you still need to have the librarians that are better at research than you are. So maybe it's going to change that, but we'll see where it is. It's going to make people that ask the right questions even more valuable.
Good point. I mean, because even robots doing certain things haven't completely wiped out the workforce of humans.
No.
So founders and investors often blur personal and business decisions. Why does that become dangerous over time? And what does clean separation actually look like in practice? Before you answer that, I'll tell you what, just for fun, we're going to go to our first trivia question here. And if you know the answer, don't say anything quite yet. We'll give the audience a little time to see if they know. What nut is actually a seed from a tropical fruit and often mistaken for a nut? So technically, it's not a nut. Okay, that's our trivia question. That's trivia question number one. All right, back to the question I was asking you. So founders and investors often blur personal and business decisions. Why does that become dangerous over time? And what does clean separation actually look like in practice?
So much bigger question in theory. So I'll try and keep it simple. As an academic doctor, so I'm a practitioner by trade, grew up, free enterprise, building businesses, and got my doctorate a little bit later in life. And in doing that, one of the requirements is you have to name stuff. So over our research over the years, we've named this phenomenon called the founder's isolation paradox. And it's as companies grow, the center of the decision-making is still at the basis of that founder. And this is companies upwards of about 100 million. So it generally escapes that. So as you get to be a larger real estate developer, in cases, as you get more and more properties, eventually you have to let go of control, because you have to bring in, otherwise you can't scale. Same in businesses along those lines. That center generally includes personal guarantees. That center also often, for most people building businesses and real estate holdings, the center of their wealth is even in what they're doing. So we have a remarkable number of founders that over 80% of their wealth is the business that they work in every single day. And what founders don't realize is there will be an exit. It'll either be on the founder's term, or it'll be on the market, or just life. Exiting there, a health issue, something else goes on, divorce, any of those things happen. Yeah.
Yeah.
It can be any of those. And so where that mix is that founders do not separate themselves. A lot of real estate investors don't separate themselves from the actual business and realize that's a way to make money. That's a way to build wealth. That's a way to, let your passions out there, but it is separate than you as a being. And so when you can do that and actually have the systems and structure around that, you can separate those so you can be truly free.
Wow. Okay. Fair enough. Tell you what, let's go back to our trivia question and see if you know the answer. What nut is actually a seed from a tropical fruit and often mistaken for a nut? What do you think?
I'm going to say sunflower seed, but I don't think that's going to be right.
That would have been a good guess, I would have thought. No, a cashew.
A cashew. Okay. I could actually see how that is. Yes. When you said tropical, that's where it's like, that's not, these are more desert flowers than they are tropical.
Yeah,
So
that's true.
Great.
Okay, I'm going to ask another trivia question. We're going to go back to more questions for you. Which leafy green is often called a superfood for its high nutrient content? Which leafy green is often called a superfood for its high nutrient content? Okay, I do want to make a mention here also for the Tahoe Lakeshore Lodge and Spa. It provides guests with an all-frank, there you go. So you're going up to Lake Tahoe, an all lakefront hotel in South Lake Tahoe, where every lodge room and condominium has a view of the lake and mountains. Enjoy fewer crowds at the Tahoe Lakeshore Lodge and Spa in beautiful Lake Tahoe, where it's the perfect time to go hiking. Even in today's weather, I'm sure there's some snow, but always good to go hiking there and skiing. So call 800-448-4577 or go to TahoeLakeshoreLodge.com and make your reservations today. Also want to make a quick mention for Mountain Mike's Pizza in San Rafael. Pizza the way it ought to be. Check them out, Mountain Mike's Pizza in San Rafael. All right, let's see what else we have here. So you talk about investor confidence as something that is built before capital is raised. What signals tell you a company or founder is truly ready for outside capital?
A lot of what we do is helping founders raise that capital. And in most cases, they are not ready. And by that, what we mean is, and where it oftentimes shows up is even in their books and records. And as it's a larger capital raise, we usually call it a data room. So if it's a small investor, it's when they don't have the information at their fingertips to be able to answer the questions that an investor will ask. So they don't know what the difference is even between a gross profit, net profit, or a net operating income, or is it a triple net, or all the various things that are actually involved with it. I found a great piece of property and I want to bring that in, or I've got a great business idea and I want to get this in. They don't have the structure around it. Okay. For most founders and even real estate type that are growing businesses that way, our pathway is being able to articulate the problem that's being solved by what it is that you're doing. So let's take a piece of real estate, and it's that you're going to be able to there's no coffee shop within 2 miles, and this traffic pattern on this corner supports that there should be a coffee store there, and we've been able to do it. The problem that we solve is that we're able to bring coffee to a drive-by market that shows the penetration there, and if we make the investment, we can build it, and that's going to be it. What most founders will do is they'll talk about the coffee shop, and we've got Starbucks, and all of those are interesting pieces, but it's really only valuable if that place needs that. And same within the founder space, right? So again, we've spent a lot of our time in that founder space. Specifically, what is the problem that you solve? So if we have a young man who's building a product right now that helps people train that are professional or high athlete cyclists for the mountains without going to the mountains. And it's very portable. And so they can get their VO2 max up higher. That's the problem that he's solving, is actually a portable mechanism for elite athletes to train.
But how big is that market, though? Right? Because you can solve a problem, but if the market's too small, then, I don't know. How big is the market?
Well, that's a great question. So you know what else uses VO2 max that's working right now, which is a much larger market? Longevity. So what if you could take all the people that are focused on living better, healthier lives, and they're wearing their Garmin and they're looking at their VO2 every morning when they wake up, and it's like, and I have a portable product that's, costs less than $300, and you can improve your VO2 without coming up to Lake Tahoe where I live, then you can do that and type scenario. So it's what problem that you're solving is usually what the founders don't actually articulate well. That's one of the fastest places they need to look, because they'll attract the right kind of capital for that. It's not about the returns. It's about the problem you're solving, because if the investor comes in only for the returns, and if they are investments, if the returns aren't there, then you have pissed off investors. Whereas if they understand that this is more of a mission that you're solving that has return possibility, then the investors also realize it's an investment.
Then the returns will be what they will be. Tell you what, we're going to see if you know the answer to our trivia question number 2. Which leafy green is often called a superfood for its high nutrient content?
The only one I'm going to think of is the one that kind of looks like dinosaur lettuce, we call it in our house, which is kale.
Yes, that is correct. And I hate that stuff. Okay, I got a cute little silly joke of the week. You ready? Okay, where do bad rainbows go? To prism. Now, it's a light sentence, but it gives them time to reflect.
That is awesome.
A good one.
I love that one. You could be a ski instructor, because we have to have bad puns and bad jokes while you're riding up on the ski lift to keep people entertained. And that would be work.
Okay, I'm going to ask another trivia question here, and we'll come back to the answer. Which luxury fashion brand has a logo with 2 interlocking C's? C's. Which luxury fashion brand has a logo with 2 interlocking C's? All right, back to our questions here. Okay, so now you've structured billions in capital, yet often warned that not all capital is good capital. How should investors and founders evaluate whether a deal actually aligns with their long-term interests?
So that takes us back to what we were just talking about. And that capital alignment method is when you find the investors that recognize the problem that you're solving and they say, me too. And ideally, they've actually already recognized it before you approach them. So I want to solve cancer. Me too. I'm going to put some money towards that. Now, as they go along the process of building companies, building real estate, whatever it is, they understand that the cycles happen in there. Banks aren't like that. Banks expect the return of their capital. And again, in the private lending side, a lot of times the lenders, especially when they're collecting private capital, forget to mention to the investors that these are great returns, but the market could change and you might need to do a capital call.
Yeah.
So when they're aligned and they understand that, you have better investors. And when you have better investor, you have better longevity as the founder or the developer within those spaces. I do in your area. I remember a very long-standing developer. Their name is still up on a lot of housing subjects. And one year, the guy, 35 years ago, he used to sit on my board. He's been passed a long time, but the family business has gone on. And I remember about 2005, everybody's patting him on the back and said, "This is the best piece of dirt. I can't believe you got this. How did you ever have this? You are so smart, so far ahead." He said, "Yeah, exactly. But for the 12 years that I covered the tax payments on this, none of my investors thought I was all that smart."
Yeah.
Right. So right, you've got to have that alignment of the investors in there. And as an investor, you also should have the alignment. If it's simply returns, there's no alignment. And so when things don't work out, it's not the right scenario.
But it's interesting because even from a return standpoint, I don't know what the dollar amounts are. You go 12 years worth of making tax payments and not getting income. You got to make 10 times on your money to say, hey, you know what? Okay, it was finally worth it. And even then, the anguish.
Huge.
Yeah.
Well, it's you know this, Edward. It's I made 200% of my money. It only counts if you tell me how long. How much time did it take?
I know. Well, it's funny because my parents bought the second house that I was very familiar with for $40,000 back in 1968, and then my mom sold it for $200,000 in 1989, and she thought, oh, that was fantastic. And I looked on my calculator and I said, that was only about a 7% return, which back then that wasn't that good. Could have made 10% on your money in the bank, so it wasn't bad, but also the thing is, if you have a loan on it and you're only paying back the loan part, then your rate of return on your capital is probably pretty decent. Okay, go ahead. Let's do our trivia question here. Which luxury fashion brand has a logo with two interlocking C's?
So it's not my space because I don't really have a lot of luxury brand stuff. But I do know because of this, I have a good friend who did the architecture for a lot of them. I'm going to say, I think it's Chanel.
You are correct. Hey, that's pretty good.
I only know it because of the logos on the building and as tenants. I don't know it because I don't even know what they sell.
Luxury brands.
Yeah.
All right. Let's see here. So for listeners trying to make sense of today's headlines, what is the one principle you rely on to filter the noise and stay focused on decisions that hold up over time?
Yeah. A number of years ago, a friend of mine who was in the financial planning side of the business. Now we're a family office and we have a private equity firm. And so we are very specific in where we are. And a bunch of educated MBAs and finance, gurus and lawyers and such as part of our group. So, but this guy's for the individual said it, I think, the best. Whatever plan you choose, stick to that plan. Because that plan, sometimes it's going to have ups, sometimes it's going to have downs. If you're always chasing what the new workout or new diet is, it's never going to work type scenario. The people who do those make it the money. So, the fundamentals for me are, if you want to be a stock investor, then pick the right stocks for you. Warren Buffett's got the great one, buy value type scenario. If you want to be a trader, find the best trader. It's an old book, but it's very thin. It's The Richest Man in Babylon. Invest in what you know. and just continue on down that plan. It can be single family homes and you can have a beautiful life off of investments for the rest of your life. It could be, commercial properties, and you're talking about having triple net leases and that type of scenario. Do not mistake trading your time for the return on your investment. And that's one of the challenges that people don't allocate back in there. If you're a professional investor, you're making the money off of your time and your thoughts. If you're a passive investor, then that's not part of the equation. So then you can get more of a true allocation of what you return. And the last one I'd say in there, don't just count your wins and don't just count your losses. Really aggregate it together and see where it is all together.
Yeah, and it's funny because I just don't have the temperament to say, okay, I'm going to do 20 different investments. They're all super risky, and all I need is like one or two of them to hit. I don't have the stomach for it, so it's not worth it to me. I did a loan years ago where the loan to value was it was a prime location in San Francisco, and the loan to value was 25%, and we charged this guy 15% and 5 points, I think, back then, and I would never do that deal again. He was such a pain in the tush. He had my attorney in court no less than 18 times in 3 years. And now, fortunately, the judge granted us all the attorney's fees. But I looked at it and said, you know what? Life is too short to deal with people like that.
Litigation fatigue is a very real scenario. And the PIA fee, we call it, is never high enough. Correct. It never is high enough. You lose your life. That's not time you get back. It's just not worth the heartache. So do business with people you like and you trust. Yeah. And, that's really the scenario.
I mean, sometimes things just happen. So now you're on our show. Are you pitching anything specifically? Like, are you trying to raise money or just sharing information?
No. So we have a website called we have a website called the Founders Office. We have a show ourselves on Wednesdays called the Lunch and Learn, where we generally work with founders on capital raising or on the paradox. So the Founders Isolation Paradox model. Generally, we work with clients that are $10 to $100 million in business, looking at they are tied to their business and they want to look to an exit or at least be free of their business. They've built a lifestyle business, but they don't have freedom. And so we help guide them through that scenario. A lot of times that's using the capital alignment so that they can have a better structured exit. Whether they actually take that exit or not, it's having it structured so that it can do that. Again, the exits come 100% of the time for founders. It's just, is it on your terms or is it on the market's or something else's terms? So, you get the best exit when, it's ready. And if you think about it from the real estate, when there's an abundance of real estate, values drop. When there's abundance of real estate that's for sale. Well, over the next decade, we're going to see an abundance of businesses that are available for sale. So it will be a buyer's market, which will be great. So a lot of our 30 and 40-year-olds that want to be business owners, there's going to be one of the best times ever to be a business owner of buying in a business now. On the opposite side, if you own a business and you want to have a proper exit that gives you valuation, that's also the right time to bring people in. So that's what we do. We also have the private equity side where we actually make the investments in these companies. But for the most part, I'm out there sharing the information that we have been working on for these last several decades.
And how do people get a hold of you, Thomas?
Probably the best way is thefoundersoffice.com, or you can also go to my website, thomasjpowell.com. LinkedIn's always great. And I will put one more pitch in there, Edward, is the Lift Pitch Tahoe. liftpitchtahoe.com. You can go out there and look at it. Is available. It's alive now. It's going to be March 1st. It's going to be a lot of fun, and it benefits. You may not be familiar with this. We have a nonprofit mountain up here where we teach thousands of kids and adults how to ski in a very expensive industry, and snowboard, and during the summer how to mountain bike. But one of the key things that we also do is we have an adaptive program for both the skiing and the mountain biking. And so the Lift Pitch is going to be raising capital for that adaptive program. And so if you're a founder, whether you're raising money for real estate or for an early stage business or a growing business, it's a great time to come up, talk to people who have money while you ride the lift. And if you aren't a skier, we're actually going to have a chairlift down on the ground that you can just sit in and have a timer go off and make your pitch. You can get better at your pitches as such. So that's liftpitchtahoe.com.
Great. Well, are you ready for our thoughts for the day? Here we go. So, brain cells die, skin cells die, and even hair cells die. But fat cells, they must have accepted Jesus Christ as their Lord and Savior because they seem to be eternal, seem to have eternal life. And sometimes I just want someone to hug me and say, I know it's hard, but you're going to be okay. Here's chocolate and $6 million.
Yeah, that would be great. I like that
Wouldn't that
one.
be great? All right, audience, tune in next week to the Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.